Welcome back to Vantage. Happy 2023 to all of you. Just before Christmas, we had the pleasure of getting a UK fund manager, well known to all of us. In a time when things were looking a little bit choppy and there's the market looking a little bit risk off, he's launched a small cap fund. Let's go take a look at why he thinks it's a good idea. I'm sure you'll find it compelling. Welcome back to Vantage. We've got a guest returning to Vantage. Delighted to have Richard Penny back on the show. Richard, you've launched a new small cap fund. Tell us the motivation behind the CRUX UK small cap fund.
Yeah, well, the main aim of it is capital gains. There won't be too much income on a small cap fund. Yeah. We think, obviously, the small cap market has been difficult. The economy will be difficult next year, but there's a lot of shares that look oversold at the minute in the way they have done in previous downturns. And we think it's a good time to launch a fund. So it's really a buyer's market, and we're positioned to be a buyer.
Okay, well, let's elaborate a little bit on that. So given the outlook does look challenging, you've got rising rates, inflation, talk of a recession going into next year, there might be a school of thought that, oh my God, let's just move to larger, more liquid names, etc. So, maybe make the case for why small cap now?
You're right, that's classic, is that when it becomes more difficult, pretty much whatever the economic situation, the psychological behaviour is mirrored. And that's the repeatable. And so people go to larger stocks, they sell out of smaller stocks, they go to simple to understand stocks. Often they'll sell the tech stocks, the healthcare stocks, more difficult to understand. Sometimes businesses with 3 or 4 divisions, they'll sell those as well. And you have, what we have seen since October of last year, is we have seen people say, oh, small cap is more difficult. And we've seen that selling happening already. So that intuitive, gosh, it's difficult, which it is, we're not denying that, has already started to get reflected in prices to such an extent where, on average now, I think it has to be quite a lot worse than everybody's already expecting for us not to be able to make money. And then there are some businesses that are actually doing quite well in this environment, which, we're trying to pick 25 names from a universe of 1,500. Mm-hmm. And then there are some that are just down more than the sort of 30 or 40% that we've seen on the AIM or the small cap market, where they're oversold because somebody started selling them and they've just got a little bit left and they just keep selling something that doesn't matter to them too much.
Okay, so valuation is a key component in terms of how you enter into the stocks, but you're trying to marry that up with those names which exhibit long-term good growth characteristics. So maybe outline to us your hypothesis as to where those growth drivers are going to be. Yeah,
so you're right. So if we can find long-term growth stocks, maybe they just slowed growth just recently, but often the prices will be off a long way. Yeah. If we can use the recession to buy those growth stocks at what, after the sell-off, is really discounted prices, that's really interesting. So, there are a lot of people talking very bullishly about technology, about flying taxis and things. We're more interested in real technology that's delivering now. Yeah. And a lot of it often you find is built off various iterations of telecoms architecture. So we know 5G is a thing, but we also know that there's huge amounts of data everywhere. So people are watching more video and there's lots of data associated around that. But we're also in an era around 5G where you'll be connecting not only people, but you'll be connecting cars, you'll be connecting smart meters, wind farms, process lines, massive quantities of data. There's no necessary information off that. You're not necessarily getting artificial intelligence. There's a need to clean up the data. There's a need to have it secure. There's a need sometimes to put that data into the cloud. And so companies that are around that kind of data processing, which we actually see doing well at the minute, FD.Tech is to do time series database. American business, American subsidiary called KX, part of FD.Tech. WANdisco has been very good at putting large amounts of data into the cloud. It's early days, but they've been winning record new orders. They need to win some more. But that has got really good momentum. And then IQE, compound semiconductors, as well as leading independent compound semiconductor wafer manufacturer. Historically, it's been great technology, well invested. Hasn't necessarily found the commercial results it should have done. But there's a new manager in there, very recent Capital Markets Day where they're talking about tripling of sales, 30% EBITDA margins out to 2027. So, partway along that path, you're going to make very good money from where we are today. It's kind of potentially multiples, but it's a 3 to 5 year journey, which we'd ask the investors to have in the small cap fund.
And you touched on tech. I know also, some of the areas in sort of healthcare. You mentioned, aging population as a big driver for long-term growth. Those particular specific areas of healthcare that or life sciences that you focus on. Any examples of that?
Yeah, it's been more the tech and around the IT, 5G and the communications at the minute. But we have bought MaxCyte, which is an old favourite, down at 470, hit highs of £12. Yeah. Since then, actually, it's moved on quite well, and we see really pretty good upside in that name. We're always looking, because your healthcare is a name where quite often the business and the technology is progressing, but they need more money. And, we position ourselves potentially to put money in at a discount for a fundraise. Yeah, that can be pretty lucrative.
Okay, and so you find, you screen the universe and you find the companies with the right kind of growth attributes. Let's marry that up with your approach to valuation. So, how do you think about valuation?
Yeah. Well, with something like an IQE, obviously we're looking at the management's idea that it can get to 3 times the sale and 3 times sales, 30% margin. Yeah. And, the journey to that might not be linear, but we sort of hold that in mind, and you can model that and get various price levels at various points, and then we would kind of work out how the company's doing against the fundamentals it needs to do that, and then what the valuation should be at that point. If I look at an FD Tech, we value the consulting business, then we look at the KX systems, work out what enterprise value to sales we're looking at, and then we'll look at some of the American metrics for those types of businesses. Just check how it scores on some of the key ratios, and then put a huge discount on it for it trading in the UK. But with IQE, WANdisco, FD Tech, there is a belief that on a 2 to 3 year view, these are sufficiently global technologies that have the potential to get to $1 billion and may cross over and get an audience from the US, which is what happened with MaxCyte when it went from £1 to £12.
Okay. Now, we've been through what I can only describe as a pretty turbulent year, particularly the sort of political chaos that we've had in the UK. So interesting time to sort of, look at a small cap fund. Yeah. Just illustrate, what's worked, the positive contributors into the portfolio, and perhaps some of the things that haven't worked, and what your view is on those.
Well, I mean, what's gone down to date has been the cyclicals, and to some extent they're anticipating bad news for next year, which there will be bad news next year. Yeah. Things that have worked. I mean, things like WANdisco has already worked for us. It's gone from 250 to best part of £6. Yeah. Continuing to hold that and buying them now it reflects the fact that we think that there is a strong order book and they will continue to convert it. What else? I mean, I think in general what we've seen is broad spread sellers of lots of things. There are a lot of things that look very cheap.
And I'd like to, you mentioned that you find sort of distressed entry points effectively. Yeah. Are there examples of those kind of things that you want to share?
Well, I think if you're looking at growth companies, even companies like Arm, which did brilliantly and then left the market, the downturns that you've seen in the past, the sort of recessions, were great times to buy that because they do get sold off. So, if I look at 98 and 99, we bought companies in video conferencing, cyber, internet, and made 5 to 10 times our money, 200 times in one case, 10. But that was 2000. We're not going to repeat that necessarily. 08, 09, the same sort of trick. We own Xaar, which you guys follow, I know, and it's 3D printing. So, quite interesting long-term prognosis. Data centers, Iomart we had, and HUTCHMED China MedTech, which has been one of the best stocks the last 20 years. Buying at really, really low valuations relative to they were well financed and they had quite a lot of their balance sheet backed up in property and cash. And in 2020, we had MaxCyte, which had this, investment thesis around enabling technology for gene and cell therapy. Yeah. £1 in the UK, actually an American business, look like American businesses, but fraction of the price. So it's kind of taking the longer term view. You know, the downside of doing that sometimes is we might be buying things that look really cheap, and the people that are selling them to us, they might just, having sold most of their holdings, sell them a bit cheaper the next day. But if you can take that slightly longer term view, you get paid for it, and we've found that.
And I guess I can contextualize that within the context of the IPO market, which has changed dramatically. So you had this very buoyant, post-COVID, rush to IPO, and there was liquidity in the market. So 2020, 2021. And then the market's completely dried up effectively in 2022. Firstly, I don't know if you participated in anything, and I'd be interested in perhaps the contrast of your demands in terms of valuation, or to enter into something now.
Yeah, so the IPO market is a function of liquidity levels, how much money fund managers have got. And when they've got loads of money and all the stuff on the market is fairly valued, there is opportunity for them to take extra money that might be coming into them and put it into new deals. Yeah. And last year we saw huge numbers of those. And to some extent that was characteristic of a market that was a bit toppy. And quite a lot of those companies now actually have gone down a very long way and start to look quite interesting. They're interesting businesses. Are they the right price yet? I mean, the auction technology groups, the Trustpilots, we're certainly looking at. And then if you take this year, of course, there's so many shares out there that are cheap. There's so many people have had to hand money back to their investors just because they've taken a view on the UK economy and said sell small companies. So many people have done that actually you've got so much choice of things you can buy in the marketplace. You don't need an IPO, and many of the businesses we can buy trade way below the price that anybody that actually owned the whole business would sell them for. Yeah. So, we have done one called Sondrel, which is a chip. It's historically been chip design, done stuff for Apple and Tesla. And initially their broker said that the valuation was £80 million for that. We had a look at it, and by the time they raised the money for the business, it was done at £30 million. So although it's a new issue, there was some tension in the price because there weren't many buyers. Yeah. And the founder and owner of the business took a view that was what he needed to get the business to a higher level, and he wasn't selling any shares, so that was acceptable to him. But for many private equity people and people like that, they wouldn't sell at the minute. Okay.
I think I've got a pretty reasonable overview of how you're positioning yourselves, and so the names that are sort of coming into the portfolio. Any ESG considerations that you take into account when you're adding to the portfolio?
So governance is incredibly important. We invest in the fund, and it's not always the case, but we're looking for the management to be invested in things. If something comes to us and wants to raise more money, why would we put money in if the management weren't putting their own money into it? Are they already owners? We like that. It doesn't always work, but it certainly helps, and it has helped us on average. On the social purposes, we do a lot in technology and healthcare, where those generally score pretty well. If we're kind of looking for growth in revenues, profits, and share prices. So where are the growth in revenues? It's often areas that are, costs, environmental and social drivers are so important to everybody. They are often growth businesses. So we may well in time find really interesting education businesses or water technology businesses. We don't have any right now, but we might find them. In terms of the environmental side, we don't do coal, but then there aren't many in small cap anyway. We would look at producing oil companies, but we wouldn't do exploration there. So it's sort of existing fields where somebody might come in and extend the life of them. And actually, what you find is that in the UK in general, we're just starting to get the data on all companies, but in small companies, there's not massive environmental data, if I'm honest.
Yeah. I think there's a journey for a lot of the small caps effectively in the next 2 or 3 years just to raise. I think everyone's trying to catch up on that. So hopefully you see some improvement in alpha as they continue to do that. So I think I've got a good understanding now of what you're looking for, which is good entry points into companies which are likely to grow over the long term, with a long-term view. So it's going to take you time to realise that, but actually that realisation, in many ways you're contrarian. So you're buying into things which other people are sort of running away from, giving you that entry point, etc. And then in a 3 to 5 year view, you hope that is going to return, a rich return effectively for the fund. Is that fair?
It is fair. I mean, I think, often the people selling are very clever people, but sometimes, after business has gone on a couple of times, they find it hard to justify what's become a very small position to their colleagues or their investment panels. Yeah. And it's easier for them to sell. And, sometimes we're often buying at the same time as the directors. I mean, we're very conscious that, in a sense, it's a zero-sum game. There's always somebody very clever trying to sell you the shares, and you've got to work out what your angle is. Yeah. Often the sellers can be technical. It might be a company. We might see this in retail, leisure next year. Some of the companies might be a bit short of money, and they might have to sell at a lower price. It's unfortunate, but we could position to be benefit from that.
Well, I'm really encouraged. It's always, for years, there was no new UK small cap fund. So, congratulations in sort of coming. And I hopefully it's an ecosystem that we'll see continue developing, because in a tough market, my view is that to get alpha, you're going to have to find those sort of great little companies which have got the potential to double revenues and double returns, etc. And that's how you're going to make your returns when the economy is struggling. Yeah. So we wish you good luck in the year ahead. We're looking forward to getting you back on to see how it's sort of panned out. Richard, thank you very much for coming on Vantage.
Thank you.